US government has a law that says you're not smart enough to invest in a hedge fund unless you are rich. Let me explain what that is and what it means for you. The SEC created a category called accredited investor. To qualify, you either need your net worth should be over $1 million, excluding your primary home, or your annual income should be over 200K or 300K combined with your spouse for 2 consecutive years. Now let's decode why this rule actually exists. The official primary reason: hedge funds are risky, complex, and illiquid. Regular investors might not understand the risk and might lose everything. So the government says only the wealthy people who can afford to lose can invest in them. Let's now understand how many people in the US actually qualify for this. Roughly 13% of US households meet this accredited category. That means 87% of Americans are legally banned from directly investing in hedge funds. Globally, the percentage is far more lower. Qualified purchaser, there is even more exclusive tier. To actually qualify for this, it requires $5 million or more in investments. Not net worth, but actual investment assets alone. This unlocks access for the most elite hedge funds, institutional investors, the real money, who creates the trends in stock market. Above qualified purchasers sits the institutional investors who are rolling the stock market. Pension funds, sovereign wealth funds, university endowments, insurance companies, and the foundations. These are LPs writing $100 million checks. What is HNI? High net worth individual. Standard HNI will have $1 million in liquid assets. Just imagine the net worth. And next comes the ultra HNIs, having $30 million in liquid assets. These investors often get white glove service, dedicated relationship managers, customized fund access, co-investment opportunities. What is NAV and why every investor watches it? NAV, net asset value of a fund, be it mutual fund or a hedge fund. It's the fund's report card. It tells every investor what their fund is worth today. Unlike mutual funds who calculate their NAV daily, hedge funds calculate their NAV monthly or on quarterly basis. That means once you invest, you get to know how's your fund performing once a month. And if you want to exit, you have to wait for monthly or quarterly redemption window. Your money is locked up. Lockup period and liquidity. Most hedge funds have lockup period for 1 to 2 years once you invest in them. Redemptions happen quarterly or annually with 30 to 90 days of notice period. Here's the real trade-off. You give up liquidity in exchange for access to strategies that require long-term horizons. Things to understand before investing in any hedge funds. There are 5. 1. Strategy. What does this fund actually do to make money? Track records. How have they performed across different market cycles? Third, very important, drawdown. What is the worst they have ever lost? Fees. Exactly what is 2 and 20 costing you annually? 2 is management fees and 20 is incentive fees. We'll discuss about it later in coming episodes. Who else is in it? Is it backed by any institutional investors? You now know who gets in and what are they signing up for. Starting next episodes, we'll go inside what does this fund actually do to make money and the strategies that have generated one of the greatest financial returns in the history. Episode 1 is where the real education begins.